All right.
Thank you.
Thanks. Excellent. Let's talk Bitcoin derivatives. It's true. I am still a derivatives trader. I traded derivatives at the large Japanese bank, as well as Visa International. And when the price of Bitcoin in 2010, 2011 timeframe was going up from $1 to $10, from $10 to $100, or even before that, from 10 cents to $1. I was like you, and I was thinking, why can't I get in to a long position like I would with gold futures or silver futures or even currency futures, corn and soybeans? Why do I have to put 100% down? I don't even have to put 100% down when I'm buying a house. And the reason is because there was no formal or reliable Bitcoin derivatives market. Likewise, when the price went up over 1,000, I couldn't just phone up someone and easily buy a put option. I would have to liquidate everything. I would have to liquidate my inventory if I wanted to lock in those gains. What we're going to talk about today is what the emerging Bitcoin derivatives market will look like. Will it look like the standard derivatives market with futures contracts that are that are highly standardized, traded on regulated exchanges? What will call options and put options look like? So let me introduce the panel that we have today, and then I'll give them a brief 3 to 5 minutes each to introduce what their companies do and how they're looking at the Bitcoin derivatives market. So starting over here on the far right, Harry Ye with Binary Financial. Harry operates out of Vancouver. The company has offices in San Francisco. And in addition to doing large block trades for Bitcoin, Harry's looking forward to getting involved in a market maker position on some of the emerging futures or derivatives exchanges, such as the ones that we have from the other panelists. We have Arthur Hayes in the middle with BitMEX, and they are about to launch an exchange in I think about 4 weeks to a month's time. And we have Joseph Lee from Btc.sx or Btc.sx operating out of London, and they have a margin traded product that also looks a lot like a CFD, a contract for difference, which you would see here in the UK, similar to something like spread betting. So why don't we start first with you, Harry, just explaining what you're looking for and what you're waiting for in terms of future derivatives markets.
Sure. So my name is Harry Ye. I'm the managing partner at Binary Financial. We're primarily traders, specifically focused on crypto, and we facilitate large block trades for high net worth clients and institutions. We're actually very, very excited about the derivatives markets. We actually believe that the derivatives markets has the potential to be much larger than the market cap of that of Bitcoin, just because of the need for hedging against volatility, being able to generate income. So for example, if I'm holding like 1,000 to 2,000 Bitcoin, I want to hedge my position, and I want to sell futures contracts or call option contracts against that and generate income. These are the kind of exciting opportunities that we're actually looking for right now as speculators in the market. So,
okay.
Yeah.
Arthur Hayes, CEO of BitMEX. My previous career was spent as a trader of ETFs and FX derivatives. So when I got into Bitcoin, I wanted to create something that I would like to trade myself as a trader. And that's why we came up with BitMEX to basically make standardized futures contracts like you would trade a S&P mini future. You can trade a Bitcoin future as well. And then after that, options, and once that's more liquid, volatility, spreads, and all sorts of other fun stuff.
So Arthur, just let me interrupt a minute. So are you going to be offering this calendar month contracts similar to other financial instruments?
So initially we'll be offering calendar month futures on Bitcoin dollar, Bitcoin renminbi, Bitcoin euro. After that, we'll be offering options on the calendar futures, and we'll also be offering calendar spreads between the months, so you can trade the implied interest rates between different tenors.
Do you plan on going a year out into the future, or more than a year?
I mean, at the beginning, it'll probably be monthly expiring and quarterly. As more people demand, I guess, a more longer term tenors, then we'll offer them. But I don't see that there's going to be much liquidity in a 1 year forward. I think most people are going to be concentrated on 1 to 3 month tenors.
Okay. Joe?
Yeah, so I'm the founder and CEO of Btc.sx, so a derivatives trading platform. Just like yourself, John, when I first got involved in Bitcoin, I wanted to find a platform, a way that I could just effectively trade both long and short without having to manage the underlying asset. And of course, this time last year, there effectively wasn't any options to do that. In order to buy long, what people have to do and what people are still doing today is borrowing that US dollar from somewhere, sending it to an exchange and just simply buying the underlying asset. To go short, there is no effective market to borrow that Bitcoin to sell on an open market. People are effectively just selling their Bitcoin holdings, which in a true sense of the term isn't really going short, it's just selling your holdings. And so, a lot of the underlying liquidity we're seeing in a lot of these exchanges is from activity from people using exchanges as trading platforms. What I think is going to be really key to Bitcoin's growth and the underlying economy is a proper derivatives platform where traders, speculators can effectively hedge their positions in a lot more smoother way than sending their Bitcoins to an exchange.
Okay, in terms of volume last year, what did Btc.sx do, and what are your margin ratios?
So we're quite proud to announce today here at CoinSummit that in our first year of trading, we processed $50 million worth of trading volume. And I mean, the numbers speak for themselves. Where we set up our platform this time last year, we saw a huge amount of traction and growth, and all of this $50 million has effectively equated to underlying liquidity in Bitcoin's economy.
How did you determine the 10% margin ratio?
Yes, sorry, I just skipped your last question. So, yeah, so we offer 10 to 1 leverage, 5 to 1 leverage, and 2 to 1 leverage. So at the time when we were looking at the market, we saw a huge amount of volatility and a lot of people wanting to take advantage of that liquidity, of that volatility, sorry. And by offering 10 to 1, it's a very high risk product. However, the demand is just exceptional.
And where do your clients come from for the most part? Which part of the world?
So all over the world. So what's unique about our product is we're Bitcoin only. So we're seeing a strong demand from pretty much the Bitcoin epicenters of the world. So your Silicon Valleys, your New Yorks, your Hong Kongs and Singapores. So pretty much where geographically there's large Bitcoin holdings.
Okay. All right. Since everyone in the audience may not be 100% familiar with the derivatives in general, I asked Harry to give us a brief overview of derivatives and their use cases for Bitcoin. For instance, one of the first ones that comes to mind, besides the speculator on the long side, would be the commercial hedger, either a miner, a merchant like Overstock. The possibility for Bitcoin derivatives would mean that the merchants accepting Bitcoin don't have to immediately liquidate. They don't have to convert through a Coinbase or a BitPay, all these huge announcements that we see. They would be able to properly maintain an inventory and manage that. So, Harry, could you walk us through how some of those trades would be structured?
Sure. So actually, I'd like to get a show of hands. How many people here have actually traded derivatives, whether it's a call option or stock option?
Oh. So yeah,
how many of you actually have not? Like, raise your hands. Okay, so half the room. So half of you actually haven't traded derivatives. So to John's point, so some of the benefits of actually being able to hedge a position would be specifically, like you said, if BitPay or Coinbase, they're processing 10,000 Bitcoins a day, rather than actually unloading them onto the market, they could either buy a put option if it actually existed, or sell futures contracts to actually generate income. And this would actually help the price of Bitcoin, in my opinion, increase, because you're actually decreasing selling pressure in a lot of ways. I think part of the reasons you're actually seeing the price of Bitcoin right now depressed is that as more merchants actually sign on, people actually think that more merchants sign on is actually good for the price of Bitcoin. It's great for the publicity of Bitcoin, but then there's always going to be constant selling, and that's actually what we see right now. Like, when you start moving large block trades, at a certain point, they have to go onto the open market, just because some buyers just can't absorb it. It's just too much risk for them to handle. Also, if you have contracts such as volatility indicators, futures contracts and options contracts are actually very, very good indicators of where the price might be headed. So for example, if, this month there's put options on Bitcoin and a lot of people are buying out of the money puts, that might be a bear signal that the price of Bitcoin might actually be dropping. So these are just kind of very, very simple examples of where derivatives actually play a huge role in, I think, taking Bitcoin really to the next price level, I believe.
I also think that proper hedging strategies will help corporate treasury management of Bitcoin. So if you're a Bitcoin company and you hold a lot of Bitcoins, how do you determine how much fiat versus how much Bitcoin do you hold and have a proper structure around that? A way that you can earn carry on your long Bitcoins would be to forward sell some of them, given that currently most forwards will trade at a contango to the spot. You can effectively earn carry while still keeping your core Bitcoin holdings. And then I think that'll help a lot of corporations become more comfortable holding a percentage of their revenue in Bitcoin.
Yeah, I guess to wrap an example around that, say for example, miners, I'm sure we've got a lot of miners in the room, they're paying a huge sums of money for really expensive mining equipment, $10,000 at a time, and a lot of times they're not going to see the return on that investment for however many months it's going to take, 2-3 months. If they had a liquid derivatives market that they can place a call and put option on, when they're paying for that equipment, they can lock in the Bitcoin's worth of value of that investment, given that they're paying for their mining equipment in US dollar. So when they see that return in Bitcoin come back in from their mining investment, their net effects, their FX risk would effectively be zero. Because what miners are currently doing when they're buying expensive equipment is that they're hoping in a way that the price will go up. But if it doesn't, it really screws them over.
And right now, even as a trader, it's very, very frustrating. When there's no volatility with Bitcoin, it's very, very difficult to make money. The only way you can make money is either you're brokering trades but you're making very, very little spreads. Whereas if you have derivatives, you can make a lot larger amount of money by actually selling contracts and allowing people to hedge their positions. So that's actually why we believe derivatives will play a huge role. And I think you're gonna start seeing a lot more mainstream. If a Wall Street firm wanted to get into Bitcoin, derivatives are a much easier way for them to get into it because they don't actually even have to own the underlying asset of Bitcoin. And I think a lot of people, they keep forgetting that what gives Bitcoin the value right now is that it's valuable in US dollar, right? So if that US dollar value isn't there and you can't hedge against that, then the value of Bitcoin is just, in my opinion, it's not going to continue to go up.
And also the volatility that
yeah.
is positive for anyone who's long Bitcoin, because essentially you're long a long-dated call option on a new technology. And if you're long any sort of option, you want to be long the volatility as well. So volatile periods are very positive for people who are long Bitcoin. I know that it's often cited as something that's a negative to adoption of Bitcoin, but if you are long Bitcoin, you should welcome volatility at this stage in its development.
Okay, I'd like to ask each one of you how you see the actual emergence in terms of the features and the mechanics of derivatives and derivative products. If you look at a traditional futures exchange like COMEX or CME or CBOT, they will have clearing members, they will have audits, they will have warehousing. You'll have to take physical delivery.
Yes.
And I'm wondering if you see it emerging in the same way or possibly in a different manner, because now we have things like BitReserve, Bitcoin 2.0 type companies where you could actually avoid the traditional warehousing techniques.
Sure.
And you could address counterparty risk in a new way. Any thoughts on that?
Actually, it's great that you mentioned that. BitGo is the first multi-sig wallet out there, and I think they're actually going to probably help pave the way in this market, because in order for you to create a custodian account for exchanges such as derivatives, you can only really do that if there's multiple signatory authorities on the account. So a service like BitGo, which is, they just raised a big round, and Will's right there. So that technology is really, really going to enable exchanges and derivatives players to really really grow, and they can leverage the brand and the counterparty risk and the custodian. All of these issues, I think, will be addressed in this version or like this year with exchanges. And I believe you guys are talking to BitGo as well.
Yes, we are. Yeah.
Yeah, I think that derivatives exchanges are going to focus on structuring contracts and making the exchange more liquid, as opposed to worrying about, are our coins going to get stolen? How does the market think that we're running fractional? If we can outsource those sort of things to BitReserve, BitGo, all these guys who are coming up with innovative products, then the marketplace for derivatives will grow that much quicker.
So yeah, talking about infrastructure, we're sitting just meters away from the old Lehman Brothers building. And one thing that we should really kind of focus in discussion is the counterparty risk aspect. So we need a lot more players to come to market with derivative-based products, because not only is underlying liquidity going to drive the growth and adoption of Bitcoin, but a nice diversification of counterparty risk by using services such as, well, plugging into different derivatives platforms with different standardization techniques for their contracts, and plugging into people like BitGo.
And even insurance, insurance is really just a form of, it's a derivative. So I think for a lot of the larger firms that are, like, what was it, Lloyd's, they wanted to get into insurance. I think by having a futures market and derivatives market, you're going to see a lot of bigger players that are going to come out and they're willing to write insurance contracts. And even hedge funds, and funds like ours, we're going to be willing to write insurance contracts against Bitcoin, because we can hedge that risk off to some other counterparty. So I think you'll see a huge explosion of derivatives that at the end of the day, it'll just benefit the price of Bitcoin, in my opinion.
Well, I do want to address the counterparty risk in a second, but just to get back to the original question, are you saying that you don't see a scenario where there will be clearing members or
no? I think there will be,
or physical warehousing.
Well, I think there will be, because right now the way the exchange models are all set up, if you look at a traditional financial market, you have the exchange, which is like the New York Stock Exchange. You have a broker, which is like Interactive Brokers, and then you have a clearinghouse, like a custodian. I think Bitcoin needs to see something very, very similar to that on exchanges. So I think the first generation you're going to see right now is BitGo is like a multi-sig wallet provider that kind of works in conjunction with maybe a fund like ours that can act as a custodian, working with an exchange. So you have all these different counterparties. So I think that you will see that. Because nobody wants to put all their eggs in one basket. Like, they've seen it with Mt. Gox, and I think right now people want to know that their Bitcoins are safe, and they want to make sure that all these companies that are backing the Bitcoins are well funded and well capitalized. So I think you're going to see an amalgamation of all these different companies.
So what about on the exchange side? With gold and silver products today, you can take physical delivery. A lot of times, if it's difficult to acquire the metal on the side of the shorts, they will force a cash settlement, and they'll say, well, it'd be nice if we could give you the silver, but how about if we give you the cash settled price plus a 20% premium? How do you think Bitcoin will, in a Bitcoin derivatives exchange, how will the physical delivery occur, especially if there's a spike to the upside and you have a lot of people that are caught short? You may not have enough in reserves on the exchange to settle with all the longs. That could be a major problem.
Well, I think for starters, most contracts are going to be cash settled, because the issue is, if I have a physically settled Bitcoin contract, how do I force the short side legally to deliver those Bitcoins to me? I don't know very many legal courts that will enforce a contract in Bitcoin. They'll enforce a contract in dollars or any other fiat currency, and you as a trader will then have a court case against you to deliver that commodity or that fiat currency. But at the moment, there's just no legal recourse in the Bitcoin sense to do a physically settled Bitcoin contract. A cash settled Bitcoin contract is possible because you can have dynamically margined exchanges and reduce the risk of someone failing quite significantly.
Yeah, so I think what this opens up discussion to is, an actual interest-bearing product and an underlying, effectively like a bond market for Bitcoins. So what we're going to see after, the futures and derivatives market kind of comes into play is, the underlying lending market kind of really coming to its own. There are, some fragmented efforts out there to create a borrowing and lending market. I think BTC Jam is currently one of the leaders in that. But what we're not seeing yet, and what can't exist yet, is a proper underlying interest rate, which will only come about from an institutional grade futures or options platform.
Well, so Arthur, if you're saying it's cash settled, then you still need the collateral. So it doesn't matter if the collateral is in Bitcoin or in another asset. How would you manage the collateral side of it?
So when you initiate a contract, you're going to have to post collateral. And as the value of that contract fluctuates before expiry, the exchange will notify you if you've come into a margin call event, i.e. your equity on the exchange has fallen below whatever the bright line level is that they have described for that contract. And hopefully, usually that buffer is quite substantial. At BitMEX, it's going to be 20% to start with. We have 20% of buffer to play with your equity to exit you out of your positions if you, as a trader, cannot manage your margin position effectively. And that's how a cash settle contract will reduce risk for the exchange.
Yeah, we use exactly the same model as you. So we have, I find that what's most effective in the Bitcoin market is a prepaid model where you're effectively posting collateral before you're allowed to open that position. And yeah, just in your instance, just like in your instance, we're also asking for 20% minimum because we have to generally try and gauge what the volatility is going to be. So we very rarely see 20% movement within a space of a tick these days. So I'm not saying it's impossible, but 20% is usually enough to cover us in terms of collateral.
Has it always been the 20%, or did you increase it?
So it effectively changes with the market volatility. We're finding 20% collateral is a safe place for us as a company to be. So we're kind of quite proactively managing our risk on our side as well, so we don't get caught effectively naked on any positions.
Right, and you also told me that you're doing forced stop losses on positions as well. And
so that's effectively what a margin call would be on a margin trading platform.
And how often do you have to go in and do that rather than the client?
I guess it depends ultimately on a client. We do have clients that just place positions and tend to forget about them. So literally when the market moves, we have to, because the client's just not logged in to press that liquidate button.
Or they're asleep.
Basically, yeah. Or if, for example, they've not, maintained enough credit in their account to keep the position open. Because instead of doing a monthly model, we're kind of a rolling spot model where we charge on a daily basis.
Mm-hmm. Okay. Well, if the contracts are cash settled, which I actually think there's a good business case towards going to cash settled, do you think it makes sense then to perhaps use a standard Bitcoin price index to base it off of, like the US dollar index is a standardized futures contract? It's a composite of several different currencies that's called the USDX. So Bitcoin already has some price indices. There's the CoinDesk one. I know Coinometrics is coming out with one, and there's several others that are out there. Could you see a futures contract being based on one of those?
I think so. The problem with a lot of these price indices is that they're very opaque in the calculation methodology and rebalance methodology. If you go to, say, traditional equities, something like MSCI Barra, who publishes, a calculation methodology, you know exactly what the index is going to include, when it will rebalance, how it will rebalance, then you as a trader can match the index. I would find it very hard for anyone to match the Winkle index or the CoinDesk or any of these indices. They kind of keep it as a black box of how they calculate these indices, and that is not going to lead to me as a derivatives exchange structuring a contract on top of that, because my traders can't hedge the underlying index, so it's eventually, why would you trade it? Just base it on one exchange.
Yeah, which is Bitstamp in this case.
Okay, I think it's also fair to say for a derivatives panel that the leader in volume right now is ICBit. Alexei from that company was invited to participate on this panel as well. So theoretically, we could have been doing trades for the last 12 to 18 months on ICBit. There's a lot of concern, even though he has standardized contracts, there's a lot of counterparty issues and jurisdictional issues with that exchange. He wasn't able to come here because of some visa issue related to Russia, but I believe they're in the process of putting their exchange and using the jurisdiction of London for ICBit, and they're in that process. I met with them in Amsterdam. But the people that we have on the panel now have all made some interesting jurisdictional choices as well. So I think it would be beneficial just to state which jurisdiction you went with and what were the reasons that you did so. So can you go first, Joe?
Yeah, sure. So we're dual incorporated in both London and Singapore. So we chose those because in terms of financial companies, you want to be located at least physically in one of the epicenters where it's happening. In order to grow out a financial market, you need to be where there is a significant financial market presence, we feel. And at the time, Singapore was very, very open towards regulatory issues that were sensitive to Bitcoin. Now that kind of picture tends to change week in, week out, but we're finding it's paying off at the minute.
Does it change the regulator for you? I mean, are you into a futures type of a regulator more than just the standard money transmitter financial regulator?
Yes, so what's difficult about regulation is the fact that, say for example, if you did set up a margin trading platform in the US, that same platform would be illegal in the UK. But there again, if you set up a CFD platform in the UK, that would be illegal in the US. And now, I think the regulators have some really interesting questions to ask themselves in how they essentially control an asset class which has no global or physical constraints to the business where contracts are being made. It's almost cloud-based nowadays.
Have you been discussing any of that with them? Or?
So we've been talking to some regulators yet. I can't disclose too many of those discussions, but they are kind of very inquisitive about what the future of the financial markets is going to look like in terms of Bitcoin.
Okay. Arthur?
We're actually incorporating in the Seychelles, and that is because Seychelles is very friendly to foreign exchange businesses. You'll find a lot of CFD, binary outfits coming out of the Seychelles, and we just felt that to get up and running quickly, go to a regime that is very forward-thinking in terms of how they manage money in foreign exchange. We actually, two of the partners, we live in Hong Kong. I know Hong Kong is not against Bitcoin. It's kind of like do what you want at the moment. And because we're crypto only, it kind of opens up the doors of where you can have yourself located. When we finally list a fiat-based contract, it will probably be in somewhere like a New Zealand or Central American country that is familiar with CFD trading in the fiat space.
Did your firm require any special licensing, or did you have to have any discussions with regulators?
No, for the Seychelles, for foreign exchange business, you don't require any special licensing.
That's attractive. And Harry, you're in a little bit of a different position in terms of licensing.
Our fund's actually a US-based fund, but we have entities that operate in Canada, US, and Hong Kong, and we also trade in China as well.
Okay. All right, at this point, I'd like to open it up to the audience for any of the derivatives questions and how you might see it evolving. Do we have any questions on Bitcoin derivatives? Do we have a microphone? And over here next, please.
Hi, Paul Calloway. I'm actually with CME Group, so I'm fairly familiar with the space overall. Can you mentioned it in passing, but can you talk a little bit about what you're using for pricing and settlement methodology? I know with kind of if you're doing cash settled for somewhat of a nascent space, what you use for the pricing and the valuation is going to be pretty key. So as the underlying space changes, how do you approach using, I guess, what fair value is for the contract?
Fair value or the expiry?
Sorry, the underlying price, like if you're doing cash settled for things like option expiry and pinning, that sort of thing. All
right, so we're, for the Bitcoin dollar contract that we'll be listing, we're going to use a reference of Bitstamp. and a 2-hour TWAP, 1-minute interval price, so time-weighted average price. Basically, that kind of mitigates the manipulation risk because it's not volume-based. So if you have a lot of volume, you can't just smash the settlement price lower. A lot of Asian exchanges that are very prone to manipulation by derivatives traders have had to change to a TWAP method. So we think that it's pretty safe.
Right here and then over there.
That's a good question.
So I should just add to that last question that, yeah, we place orders out straight out to market at Bitstamp as well. So at the minute, we pretty much have to choose who provides the most liquid market as well, because liquidity is, the key driver for growth. I mean, it's really difficult for us to use a market that's really illiquid equally, as it's quite difficult for us to plug into a China exchange, given that a lot of the trading volume is almost like it's synthetic. Yeah.
I'm glad CME is here, though. It's official now.
You're on Twitter now, buddy.
Famous.
Hiya, Nick Z from MX Exchange. Just a quick question to you guys. What do you expect to happen to Bitcoin volatility going forward? There's a lot of talk about how it's inhibited, uptake of Bitcoin. You guys work in derivatives, so you must have hopefully some kind of opinion of what's going to happen going forward with the volatility.
I think right now, if I had a liquid options chain to trade, I would be trading 90-day straddles because I think that the volatility currently is quite suppressed. If you look at 30-day realized, it's about 50 vols at the moment, come down from about 300 last fall. So volatility at the moment is at kind of a low point in the last year, and I think the seasonality of Q3, Q4 will see volatility pick up and more on the upside. So I would expect call over skew for if you're going to put on some risk reversals.
Yeah, I think tying in what Harry said earlier, there's a lot of sell-side pressure from all these merchants coming on board. And in the derivatives market, I mean, we only see that as temporary activity, which kind of leads to short-term volatility. That's not necessarily bad, but it does suppress the price from where it wants to be effectively.
I would think that also we would see over time as the Bitcoin futures markets mature, we should see less volatility overall because we won't see wholesale dumping and everybody kind of freaking out during a market move. It should, in theory, overall have the effect of reducing volatility.
Yeah, I think, Arthur, you presented about a volatility index in Hong Kong. Maybe you want to share a bit about that.
Yeah, so I think that what Bitcoin needs is something like a VIX index, and that'll come about once we have, I guess, a liquid chain of strikes across, say, Bitcoin dollar, and then we can start having, a Bitcoin VIX. We can start trading variance swaps on Bitcoin. I think we're years away from that, but as us and other players get involved in the options space, it's definitely going to be a very interesting product to start trading.
Yeah, we think it's the most exciting thing to trade, actually.
Now you just need to find some shorts for your long straddle there.
Yeah, exactly.
Hello. Laurent Leclerc from Argental. We are an investment office, family offices investing in financial services. Just some thoughts some food for thoughts, more than a question. We just spent previous session kind of banking bashing, and this session is more about trading, so I'm back into my old days at Nextdoor. So that's very interesting to see these things. But I just want to mention BNP Paribas fine was mentioned a couple of minutes ago, and just want to explain what the fine is about, because it could be a very important and interesting parallel with what's happening in Bitcoin and with the regulator. BNP Paribas was fined $9 billion just by doing one thing, transacting in dollars with some entities that they were not authorized to transact in dollars. So basically what they're saying is that, and it was 9 years ago or 10 years ago, not 2 years ago. So they have been fined $9 billion for transacting in a currency for a country and with entities that were not allowed to transact in this currency. So, having said that, they use dollars. They have been used a derivative on dollars, it will be more difficult for the SEC to find them because they didn't hold the currency or the commodities they transact on. My question to you is, how are you going to make sure that the derivative market is not going to be the best way for ISIS with the $500 million money that they got from Iraq and from the bank in Iraq to go into Bitcoin through you guys?
Well, it's not physical, so it's a sum-zero game in any derivatives market. So just because they want to move billions of, whatever currency, they'd actually have to make billions of currency on the derivatives platform before they'd ever be able to move it somewhere. So it's not as easy as just saying, I have $1 billion US, let's go trade some Bitcoin derivatives. It's probably the worst thing you could do.
Actually, just to add to that too, I mean, to trade, these products that we're talking about, they're institutional products, not necessarily, like signing up on an account on Coinbase. The KYC procedures I think you're going to see on these exchanges it's designed for institutional traders. So I don't think you're going to see those types of people come onto these platforms. So
yeah, that to me just sounds like an AML KYC question.
Yeah, it's an AML KYC question. Yeah.
AML and KYC is a well-established process that Bitcoin companies nowadays are all pretty much following.
Okay, thank you,
right.
Thank you.
And thanks to my great panel.
Yeah, great moderator. Thank you.